So, good afternoon, everybody. And as we do with these sessions, a slow welcome to the Unity Renowned Speaker session. The reason it's a slow welcome is that Zoom slowly brings everybody into the room and gets them to hear me. And as I speak, we have people trying to join all the time. So, good afternoon. Very excited this afternoon to have Mark Smith with us from Cotswold Barristers. Mark is famous for his £27.5 million win against the West Bromwich Building Society back in 2016, which he took on as a class action on behalf of 6,200 landlords against some unfair interest changes that they made to their mortgage policies. So Mark is a tax barrister at Cotswold Barristers, and he's also honorary counsel to Property 118. So without further ado, I'm going to hand over to Mark, and he's going to talk to us and then subsequently take questions from us. So Mark.
Thank you very much, Rupert, and good afternoon, everybody. I'll go straight into the presentation. I've got a list of participants here and mention one or two of those who know that they are my clients. I'll say hello to them. Those who are about to become my clients, I'll say hello to them as well. Obviously won't give names out, but welcome along to everybody who's joined this afternoon. Rupert, thanks for the invitation and thanks for the welcome. The title of this talk is, Are You Paying Too Much Tax on Your Property Business? And as Rupert's told you, I am the Honorary Legal Counsel for Property 118, and it's along with Property 118, which is a fantastic free resource for private renter sector landlords and others. I present and implement various tax efficient strategies to make sure that your business is as tax efficient as it can be. So just a little bit about me. I qualified as a solicitor in 1986. I've been a barrister since 1996. I am a head of chambers at Cotswold Barristers. We're based in Cirencester. And as Rupert said, I, along with support staff here and obviously the team at Property 118, carried out a case against West Bromwich Mortgage Company, which ended in 2016. They had intended to, if they could get away with it, increase the interest rate on their tracker mortgages from 1.99% above base to 3.99% above base. And everybody who got those letters wondered how it could be a tracker if you could increase the margin above the base rate. So a legal challenge was mounted. We had about 250 members of Property 118 perform the action group. The war chest was put together to fund the West Bromwich's fees. In case we lost, we had to secure those fees, put a deposit into court, which we did. So they couldn't divide and rule. It was the group action that was really beneficial from that point of view. And after a loss in the first case in the High Court, we won in the Court of Appeal, and everybody's mortgage interest was refunded. The original terms were restored, so 1.99% above base, and additional ruling that the mortgage company could not call the loans back in the absence of an event of default, which is also quite important, because West Brom did threaten that that would happen. If they lost the case, they would simply call the loans in. The court said, no, you can't do that. 25-year loan is a 25-year loan, and if the borrower doesn't default, you can't call the loan in, except in very, very clear circumstances that must be specified in the contract before you start. So that was 2016. Everybody was delighted with that for about a week. And then they said, well, here's Section 24. What are you going to do about that? So since that point, for the last nearly 5 years now, we've been working on various initiatives and structures to help landlords make their property rental businesses as efficient as they can be. So we are going to look at today deeds of trust, partnerships, incorporation without refinancing, and strategies that flow from that, creation of directors' loan balances and protection of IHT by the freezer growth share strategy. And as we go through this, you will see that there are always links to the HMRC manuals, and you can view this presentation online at property118.com/tax. You can see articles and further information about everything that we have planned and developed, and you can also make any individual inquiries to me with that email address there. So that's what we're going to be looking at this afternoon. So what we might call entry-level tax planning is simple declaration of trust. This is the first example. Mrs. X, in this case, is a 40% higher rate taxpayer. She's got 3 properties and her spouse has no income. So we can simply reallocate the beneficial interest in those properties to Mr. X, and the benefit of that is, because he has no income, we're not wasting the first £50,000 of rental income on high rate tax. We can top slice £50,000 from Mrs. X's higher rate tax bill and reallocate that to Mr. X. He will pay no tax on the first 12,500 and just 20% basic rate on the next 37.5. And of course, those are the rates from 1920, the tax year that we've just finished. So that's very simple level of tax planning that costs £250 plus VAT to achieve that tax benefit. And we have done that for a number of clients. So moving up to the next level, people taking their property rental business a little more seriously. In this case, Mr. and Mrs. Y are higher rate taxpayers both, and between them they have 4 HMOs. They also have 3 children, of course, thinking about their succession. The children, adult age children, 18, 21 and 22. They're all students. They have no income of their own. So in this case, they unusually, you might think, do help manage the HMOs. So we can form, in this case, a general partnership. So there will be 5 members, Mr. and Mrs. Y, who are the owners of the HMOs, and 3 children who do assist in the operation of the business. Now, the benefit of that is that we can allocate profits. Now, bear in mind, there's a difference between allocation of profits and drawings, okay? We can allocate profits disproportionate to ownership. So the children come in with no property to introduce to the business, but they are members of the partnership. We can allocate rental profits to the children. They do not have any other income, so they can draw money to pay their tax, but we retain the rest of that income on the partnership balance sheet to grow their capital accounts, grow their stake in the business, if you like. Mr. and Mrs. Y, the parents, continue to draw money out of the business. They draw from their capital accounts, their own money that they've introduced into the business. So there's no tax on what they draw. But of course, the more they draw, the more their stake in the business reduces, because they're not being allocated profit, they're being allocated capital. And as a consequence, Mr. and Mrs. Y can draw more out of the business than previously, because they're not paying tax on the profits that come into the business. They are reducing their capital account, so that has an inheritance tax benefit, and it also means we can utilise the nil and basic rate tax bands that would otherwise be lost because of the 3 children not having any other income. So again, there on that strategy, we are saving from Mr. and Mrs. Y 40% tax band, £150,000. So we're top slicing that off, reallocating that to the children. The only money that comes out of the business is enough to pay the children's tax band, which is again minimal if we're only allocating £50,000 to them. And we are growing their capital, their stake in the business, and reducing the amount of inheritance tax that eventually will have to be paid. So again, that's something that can be done quite straightforwardly. There's no qualification needed for that to be allowed by HMRC. It can be done without any permission or leave from HMRC. You don't have to qualify for that at all. The next more sophisticated structure that we are introducing a lot for clients is the limited liability partnership, the LLP. Now, although this is called a partnership, it is in fact more akin to a company in many ways. The structure has its own legal personality like a company has. So it is registered at Companies House. It has regulatory requirements in terms of filing of accounts and registering persons of significant control. But in other ways, it does have the same tax benefit features as a general partnership does. So again, you can allocate the profits of the business in any way that the members agree. So the same benefits accrue where you have members who don't have any other income. Their nil and basic rate tax bands are utilised, and you can start on IHT planning by reducing the capital account balances for the older members of the business and increasing those allocated to the younger members, so helping succession planning in a long-term way through the incorporation of this business. So we have created a lot of these, and they are beneficial in the medium and long term as well. So bear in mind, please, and keep the idea of partnership in place, because that's very important. We'll come back to this in a minute. So the key thing that I guess most people are interested in, and the hot topic that has been in tax planning for some years now, is the loss of finance cost relief. You remember this was Mr. Osborne's last hurrah before he went off to edit the Evening Standard and run his private equity company. He reduced in steps the amount that private rented sector landlords could claim against their finance costs in relation to tax. And in the tax year that we've just finished, 75% of your finance costs will not be allowable against your income. This year, 100%, the tax year that we've just begun, not a penny of your finance costs will be allowable against income tax. But rental businesses that are held in limited companies will still be able to claim all of their finance costs as expenses of the business. So what we were asked on more than one occasion back in 2015, can we incorporate into a company without having to rearrange all the financing? Of course, it's very easy to sell your business to a company. Are there tax implications for doing so? Because a company is, of course, a separate legal entity. Are there mortgage implications? Because the company will then have to take over, with a straightforward incorporation, all of the mortgage finance. Now, that may not be available for many people. So in some parts of the country, it's virtually impossible. If you have been in the business for some time, you may well have refinanced more than one occasion, and in the classic way that many landlord businesses have been run. You may not have enough equity in your portfolio to justify being able to refinance. You may not be attractive to a company for that reason, because of age, credit issues, whatever it may be. Can it be done without having to rearrange all of your financing? Well, the answer is yes, it can, by and large. If you are a partnership, that's the first thing. So the sort of partnerships we have described, the family partnership, the LLP, even the type of partner who, type of partnership where there is no formality. You may be a husband and wife. You bought properties together. You're both on the mortgage. You share the income. You share the liabilities. You've been operating on that basis for some time. That is, in law, a partnership, because a partnership is a question of fact. Are you two or more people engaged in business with a view to making profit? There's no need for any formality. There is no need for any registration with HMRC, because you're not a trading company. It's simply a question of fact. And if you are a partnership, you can transfer the whole of your business into a company without attracting capital gains tax. That's the first thing. Because you'll know when you sell one or more of your properties, you will pay capital gains tax on any profit that you make. The same would go if you sold a property to a company. But there is a provision that allows you to sell the whole of the business to a company in one go in exchange for shares. And any capital gain that would accrue at that stage is rolled into the shares. So you would only pay the capital gains tax at that stage if you sold in the future any of the shares. Selling the properties themselves would only attract tax on the company, and even then, that would only be on any profit that you make between incorporation and sale. So the capital gains that have accrued over the years that you've run the business are not taxed unless you dispose of the shares. So that's very attractive for a number of people. And you may say, what's the point of that? How is that allowed? Well, the idea is that you can move your business from one type of structure to another The beneficial ownership is the same. You're still in reality the owner of the business. You're just running it through a company rather than individually. And so there is no artificial tax penalty for capital gains if you move your business into a limited company. So that's very attractive. Consider the amount of gain that there is built up in your portfolio. That could be a significant tax saving if you're able to incorporate. SDLT, again, partnerships generally can incorporate with no SDLT paid. The company would not pay SDLT if the beneficial ownership of the business is the same in the company, so the same shares that there were in the partnership are allocated in the company. No SDLT is payable. No exemption, regrettably, for sole traders. Sole traders cannot incorporate in that way without SDLT being payable. But if you incorporate and run a partnership for 3 years before you move it into a company, then SDLT would not be charged if you then incorporate into a limited company business. So if we're a partnership, if we've been operating for 3 years, we can incorporate into a company without any tax payable on that first day. How do you know if you are a property business? Well, there are a number of different definitions across the manuals. The one that is in the property income manual says that anybody who gets profits or income from their holding of land or property in the UK is running a property business, even if there is an agent carrying on the business for them. We don't rely on that for these purposes. We rely on the capital gains tax manual that says, and it's a bit more of an onerous obligation on you as a business owner, incorporation relief will be available where you spend 20 hours or more a week personally undertaking the sort of activities that are indicative of a business, but other cases should be considered carefully. This comes from a case from Northern Ireland called Ramsey in the HMRC. Mrs. Ramsey had a block of 10 flats. That was the extent of her business, one block of 10 flats, 5 were occupied and 5 were being prepared for occupancy. And she operated and looked after those premises, checking tenants in and out, looking after the common parts, that sort of thing. And she wanted to incorporate. Now, the HMRC challenged her entitlement to incorporation relief because they said what she was doing was just what any landlord would do when they're curating their investment. She wasn't running a business, but the upper tier tribunal said that she was. That was sufficient, and this is where this thumbnail of 20 hours a week comes from. Additionally, other cases should be considered carefully, and this really relates to ownership being a responsibility, even if you have agents or contractors working for you. Even if you subcontract some or all of the business that you carry out, you are still legally accountable for what these agents do. Letting agents, employees, contractors, although they are working for you, you are still legally accountable for what they do. So it must be said, most of our clients are hands-on landlords themselves, but you are entitled to contract out some aspects of the business without falling foul of this rule. And so we know through having done around 300 of these incorporations what it is that will qualify and what won't. And we have not had any adverse consequences from HMRC about the clients that we've recommended for incorporation. So you can incorporate without refinancing using the substantial incorporation structure. This is how we're able to get you into the company tax regime, having all your CGT saved and rolled into the shares and having all of your finance costs relieved by using the substantial incorporation structure. If you're a partnership, this is the way to go. Not tax avoidance, make that perfectly clear. You actually accelerate the tax point. The only additional benefit is that you don't have to refinance until it makes commercial sense to do so. So as I've said, where the early repayment period comes to an end or the product comes to an end, you have to refinance at that point, but you don't have to do so at the point of incorporation, which gives you a lot more flexibility. So what we do is we sell the beneficial interests in the properties and all the other assets to the new company. The beneficial interest is the economic benefit of owning the property. So that's the right to the income, the right to the sale proceeds. It's being the true economic owner of the property. Now that is where the taxation is applied. HMRC will tax the beneficial owner of an asset and on its income from that asset, not the legal owner. So HMRC being having really no choice, they must agree that that is qualifying for incorporation relief, and we know from our dealings with them that they have no issue with this. They couldn't say on the one hand, well, we're going to tax beneficial ownership, we're going to look behind the legal ownership to see who the beneficial owner is, and that's where the tax will be. Well, we're taking that principle and saying, well, that's fine, we'll work with that, because it means we can incorporate without having to change the legal ownership. And HMRC agreed that that qualifies for incorporation relief, so your CGT would be wiped away and put into the shares. And you would leave the legal interest, that's the interest that's registered at the land registry, and you leave that in your personal name until it makes commercial sense to refinance into the company name. And you, as the individual legal owners registered at the land registry, will hold that estate in trust until you refinance into the company. So that separates really the financing and the taxation aspects of your business. And it means that the company can write off all of the finance costs against its income before it calculates its profit and before you draw your finance out. And it can stay like that for as long as it makes commercial sense to leave the mortgages in place where they are. When you want to refinance into the company, there is no CGT or SDLT payable at that point. The reason for that is that you have already dealt with the CGT, that's been added into the shares, and you're not making any disposal of anything that has value when you move the legal estate into the company. Because the company already owns all of the financial benefit of the property, the beneficial interest, the legal estate on its own has no value. And as a consequence, there is no gain and there is no consideration of any value for SDLT purposes. So when you move the legal estate and you unify the legal and beneficial estate into the company, there is no additional tax payable at that point. Because part of what we do when we do incorporate the business is to have a contract for sale. So you'll know when you buy a property, you exchange contracts and you complete, and there's a time lag between the exchange and the completion. Well, in this case, we exchange contracts, but we don't complete for months or years, not 14 days or 21 days. It can be delayed for as long as is necessary before you refinance and complete the transfer to the company. So we have a contract, a delayed completion. The new company will have the beneficial interest in its hands at the stage of exchange anyway, but we make that plain with the business sale agreement. And through our experience, we've found that lenders treat the transaction as a purchase rather than a refinancing. And it makes life a lot easier when you're looking for a purchase transaction rather than a refinancing. As I've said, no SDLT. You've already dealt with that because it's a partnership exemption at stage 1. Stage 2, the refinancing, there's no value in the transaction. And again, CGT would be nil because there is no disposal of an asset with any gain attached. So that's how we do it. That's how you can reincorporate your business into a company without having to take out new mortgage finance at the time of incorporation. Now you may ask, what about the lenders? A lot of people do. Surprisingly, you might think most buy-to-let products do not prevent you dealing with the beneficial interest in this way. Portfolio loans do, because they're written on commercial terms more often, and there are stress tests and other requirements about the way you conduct the business, but single BTL products don't. The reason for that is quite simple. If you default on payments, the fact that you have not, transferred the beneficial interest away into the company doesn't affect the lender security one jot, because their rights override anything that you do with the beneficial interest. There is no impediment to them enforcing security, because the law in relation to this says that their rights registered as they are at Land Registry. Again, you personally override anything that you do with the beneficial interest. So you are still personally on the hook to the mortgage lender. The company is on the hook to you because that's what makes it tax deductible in their hands. They've got to indemnify you, pay you the money to pay the lender, but you are still liable to them as the legal owner. So that's why most mortgages are not, do not prohibit this process. But once you have got it into the company in the beneficial interest in that way, you can claim all of your mortgage interest and other finance costs against tax because it's the company liability and companies are exempt, not affected by Section 24. So it makes your business more successful, more cash rich, more sustainable, more scalable. And as I say, we've done around 300 of these now, and we have had no adverse consequences from HMRC. They understand what we do, have no issues with it, and nor can they, so they don't. A couple of other things that we need to speak about this. Refinancing, we've got a panel of solicitors and brokers who are familiar with this process, and we can assist and do assist dealing with mortgage companies and lenders at that point. And this is the explanation that enables the refinancing to be done straightforwardly once the mortgage is appropriately moved into the company at the time where it makes commercial sense to do so. So as I say, we have assisted in many refinancings into the companies. There is a body of knowledge in the mortgage industry now that understands what this process is. It was very novel when it came out, but it is now well established, and mortgage lenders do understand what it is we're looking to do and the reason why we're doing it. I think they do understand that companies who operate property rental businesses are now more sustainable. They are better funded, more robust, and a better risk for lending purposes. Okay, a couple of other things to mention in relation to incorporation, the capital account restructure. This example here is where a partnership has got very little in terms of mortgage liability on it, but incorporation is still very attractive for CGT, perhaps other reasons. So the example here is, well, let me just wind back. Let me give you an example. Think of a business who has, they've spent £2 million on buying their portfolio. So their base cost, what we call the base cost for these purposes, £2 million. The mortgage loans across the portfolio are £1 million. So there's a £1 million gap. If that business was incorporated without this restructure, then that £1 million would sit in the share premium account, and it's difficult to get at that. Even though it's your taxed post-tax money, it's still difficult to get hold of that money without a further tax liability. So what we're able to do is take a short-term bridge. So that £1 million gap, you will borrow that from a private financier, which we can introduce you to. The business would then be incorporated, and you would take that £1 million and lend it to the company, because the company would have assumed the debt to the financier. So the £1 million debt that you owed the financier has moved across to the company. It becomes a company debt, and you would lend the money to the company to repay that bridging finance. It's all done in a very short space of time. Consequence of that is that the company owes you a director's loan of £1 million, and the tax on taking that out is 0%. 0%, tax-free, exactly the same as it would be if you took your own money out of the business before it was incorporated. So that is something that is, again, attractive to a number of people who have run their businesses carefully. They haven't refinanced excessively. They've kept a good low level of gearing, and this is a benefit that can accrue to them if they incorporate and use that restructuring process. They take their own money out of the business before it is incorporated, lend it back to the company to repay the loan, and this is perfectly permitted by HMRC manuals. HMRC manuals do say clearly that you can take out interest-bearing finance to keep the business capitalized if you withdraw the money that you introduced it into the first place. I'm sure many of you have done these deals where you would put a bit of money in, do a property up, refinance it and take your money out again. That's exactly the same sort of thing, but you do this across the whole portfolio, not just on one or two individual properties. So again, that can be a great benefit to people who are able then to have a tax-free flow of income coming out of company profits. Finally, to talk about estate planning for AHT mitigation, freezer and growth shares, there are two types of share that we can implement in this process. The first type of share is the freezer share structure. Now, these are A shares, and they will have all of the value of the company at the date of creation. So going back to that example, the company would have a value of £2 million. These A shares would have the value of £2 million ascribed to them. And those A shares would also have the voting rights and the dividend rights, so they have full control of the company, all of the income, but the value of the shares that's attributed to them is frozen at £2 million. Then you create B shares. They have no initial value, no voting rights, no dividend rights. They are valueless at the time of creation, so there's no tax implication about allotting those to your chosen successor. But the future growth of the company accrues to the B shares. So in 10, 15, 20 years' time, when you pass on and AHT is calculated, your AHT estate will be capped at the £2 million that are ascribed to the A shares, and any capital growth, which hopefully will be significant since that date, will sit on the B shares outside your estate and therefore not chargeable to inheritance tax. So that is a significant piece of planning we can do to mitigate. We can't wipe it out, but we can mitigate the amount of AHT that will be charged on your property rental business at the time of your passing. Of course, you won't get the benefit of it, but it's nice to have peace of mind that those of you who are left behind will not have an excessive tax bill to think about at that point. So, how to find out more? It's run through property118.com/tax. They deal with all the consultation, all the fact finding. They make recommendations. You can book a consultation with a tax consultant at that web address, 118.com/tax. It costs £400. It's got a money back guarantee if you don't like what you hear, or if you do like what you hear but you just want your money back, you just ask and you'll get it given back. But if you like what you hear and you want to go further, you then book a consultation with me and your consultant through that link, and I will be able to give further qualified and insured professional advice about the recommendations that you're given and quote you for putting those into play. Various fees are involved at that stage, but you only pay those fees if you decide you want to go ahead once you've had all of the tax benefits explained to you about the strategy that has been recommended. So if you want to know more, please click on that link, property118.com/tax, or you can email me for any other individual queries or for a brief discussion, but I will be recommending you onto 118.com for the full consultation process. The reason for that is that there's been a lot of money spent on a wonderful piece of software that gathers all the information we need, gives all the financial illustrations of the various options that there are, and gives you full, clear understanding of what you get if you decided to go ahead with the recommendation, the benefits that would accrue. Of course, you'll also be told if there aren't any benefits, and you can have your money back. And it's been nice to meet you, but we couldn't do anything for you. That's part of it. Everybody's case is different. Everybody's at different stages in their property journey. And these are the options that we can create for you, depending on whether you're beginning, middle and end of your property investment journey. So that's the end of the presentation. I shall now hand back to Rupert, and I'm sure that...
Thank you so much. And hearing it and seeing you speak and talk through it makes it so much more beneficial for me, and I'm sure for other people, particularly those that have read what you have said in the past and perhaps read in just parts of it. So we've got a couple of questions. I've brought June into the room. We can't see her, but hopefully we can hear her. If not, I'll read out her question myself. But June, can we hear you? No, we can't. So we'll mute her once more, and I don't know if you can see the question there, but it's, I understand freezer and growth shares, but to implement them right from the creation of the limited company, would that not be seen as solely for inheritance tax purposes?
Would it be, the question is, would it be seen as tax avoidance?
Yeah.
No, it's not tax avoidance. It's a perfectly common piece of planning, and it is something that is operated by companies for employee incentives, as well as in these circumstances as well. So it's a perfectly well-known and common piece of planning, and it's not at all as vulnerable to attack as inheritance tax avoidance. Tax avoidance is an improper or artificial step that has no benefit other than to save tax. This is something that helps you plan your succession and keeps the success of the business intact for years to come. So it is not anything that I've known of as HMRC challenging as an improper piece of tax evasion or avoidance, I should say. So quite happy with that. Hello, Lou Voldini. Thanks very much. Nice to hear from you again.
Yeah. So we've got Rich. We've brought him up on the screen. Rich has got a question for you as well.
Hi, Richard. Unmute the mic and we'll hear you.
There you go. Is that better?
Yeah, great. Hi.
Yeah, I've got a few questions, but it just depends what time you've got. But the question I posted would, because you're in when you're in a partnership and before you incorporate, because you're still not a company, can you refinance under your personal name?
You can refinance in your personal name when you're within the partnership, certainly. You can, in theory, do it after incorporation as well. You would still hold the property on trust for the company. But we do recommend that you avoid that if possible and try to bring everything into the company name through time. The reason for that is if you do pass away with mortgages in your own name, it's really difficult for your successors to have to refinance straight away because mortgages will be called in at that point. So we do try and encourage loans to be put into the name of the company at the convenient point, but certainly before you pass on.
The reason I ask is because at the moment I'm in a full-time employment, and at the moment I'm in a higher taxpayer for my, just below higher taxpayer for my employment and just below higher taxpayer for my property. So at the moment it benefits me to incorporate. Obviously, if I leave my job, would it benefit me then? And if not, then obviously that's when the question around refinancing, we could leave it under the partnership and not incorporate.
Yeah, it's all a matter of numbers. Not everybody will benefit from incorporation if you've only got investments in a small way, or if you're not in a higher rate tax band for your own employment. But anybody who is getting into the level where you qualify as a business for CGT purposes, the 20 hours a week rule or rule of thumb, then you will almost certainly be in the higher rate tax band. And bear in mind that all of your mortgage payments are deemed to be tax. You get a 20% tax credit, but they can inadvertently throw you into the higher rate tax band before, even if you didn't think that you would be, because they are still deemed to be part of your income. You don't get tax relief from.
So thanks for that. And a few people have brought themselves into the room, which I think is a good idea if they've got questions to ask. So if you are queuing up to ask a question, just start your video so we can see you. And I'll come on to Craig and Richard in a second. So we've got Imran. I'm not sure if he came to the discussion late. He said, I own the BTLs in my name and not in a partnership.
Yeah. Well, in that case, it's more difficult for Imran to think about incorporating because there's no SDLT exemption. He's a sole trader, so he's really got to think about getting into a partnership, either form a company to buy some properties in and form a partnership in that way, or team up with another investor to form a business partnership, or even a spouse or family member. But at the moment,
and of course, Mark, you and Mark Alexander put this program together, this structuring together a few years ago, in order that people can get in advance of the heavier tax burdens that have come down the line.
Yeah, this is. I mean, I speak at when we were able to have public events. I do speak at public events, and excuse me, nearly always ask the question: how many people are affected by Section 24? How many know the effect it's going to have on their business? How many have taken steps to deal with it? And there's always diminishing numbers as each of the questions get asked. So I hope that people will inform themselves about the effect that this is going to have on them, and take steps. Even taking steps late is better than not doing anything at all.
So attempting to take further questions in turn. Craig, do you have a question?
Yep. Quick one. I've recently had the consultation with the other Mark, but one of the questions I forgot to ask, I have two limited companies. One is FM Expert, which I use as my day job as a facility management consultant, which is a VAT registered company. The other one I've recently set up is the Shepherd Property Limited, which I was going to use to buy commercial property. Which is the better one to buy commercial property through? One that's VAT registered or one that isn't VAT registered? Or does it depend on whether the property I'm buying is designated for VAT?
Yeah, you've answered your own question. Correct. It all depends on which what the VAT status of the commercial property is. I mean, if you're talking about residential, then steer away from a VAT registered company. Steer away from one that's registered as a trading company.
So I'm looking at commercial property.
Yeah, so it all depends on the VAT status. If they've elected for VAT, then it should go in the VAT registered company. If not, then keep it in Shepherd Property Limited.
Yeah, cool. Magic, thank you.
Okay, well, good luck with that.
And moving on to Richard. Hi, Richard. Can we hear you? I'm unmuting you now, Richard, so we should be able to hear you.
Is that myself, Rupert?
Yeah, yeah.
Ah, okay. Yeah, so I didn't particularly have any more questions. Hi, Mark, again. As you know, I've already had a consultation with Mark, and it's helped again today as a big refresher, because there was one or two things that I wasn't entirely sure of. I mean, I think Mark's explained today very well why when you transfer the beneficial interest, if you've got single buy-to-lets, it works, but if you've got a portfolio product, it doesn't. So I think that's been very helpful for me today, because it's made it quite clear that we were able to do so. I'm probably on the cusp, Mark, of moving forward with this now. Next week I have funds secured, so I will be in touch.
Good. Just a point on portfolio loans. Some mortgage lenders are happy to work with us to give permission to allow these to be ported over once they understand that their security isn't affected. We've had some with major high street lenders who have been quite happy to go ahead and allow the incorporation to take place.
From my point of view, Mark, just for your reference, when I were looking at funds, I approached my own bankers I've had for years, NatWest, and they were obviously asking about it, and I said to them, look, I'm not coming to you for the validity of what we're about to do, because I have a barrister for that. Yeah. I'm just looking for funds, but irrespective of that, they passed it to NatWest Security, the main people, and they passed it as okay. It came back as fine.
Good. Excellent. Well, that's good to know.
Because part of, I've got a couple of loans with the bank that would have been affected, yeah, and by transferring the beneficial interest. So I guess that's why they referred it.
Right, yeah, but I hope so. Really good to hear that, and thanks for.
That's quite a statement, really, isn't it, Richard? Because I think in the back of everybody's mind is the concern as to what could happen years down the line and whether or not HMRC calling. And with that in mind, actually, it's probably a good time for me to ask a question I've got, Mark, and I hope I don't put you too much on the spot here. But with 300 already being done. Given that you're going through a staged process over a number of years, have any of those 300 actually got to the incorporation stage and run a year of being incorporated and still escaped any HMRC attention?
Yes, I don't want anybody to misunderstand. The 300 are the businesses that we moved into companies using these structures. So we're not talking about partnerships, we're talking about actual incorporations and then into limited companies. So the first ones we did at the end were at the end of 2015, early 2016. So these ones using the beneficial interest transfer as it was then, SIS as it is now, we've had many of these go through 3 or 4 tax cycles without any queries being raised, anything adverse from HMRC. We have had, I think, 3 aspect inquiries from HMRC about the CGT relief. All of those have been answered satisfactorily. The HMRC have got no issue with the principle of what we're doing. They just need to make sure by dip samples that the incorporation relief is correctly being claimed, and we've answered the queries and they've been quite satisfied. So in terms of the principles, we know they're happy with the principle. It's just in individual cases they do a cross check, which we've been able to do with assisting our clients and their accountants to do that. Right. I should say that there is no additional charge for that work. When you take us on to do this, you pay a fee in advance and the work's done, and there's never anything additional to pay. If you need any support with your lender, HMRC inquiries or anything of that sort, or even, heaven forbid, it should go to a challenge or the tribunal, that is something I do at no extra cost. And the reason for that is because I want to show that we have worked very hard on this and we understand that it's robust, and nobody would argue it better than me on your behalf, put it that way, because I designed it. So I don't want to be doing work for free. So I'm telling you, I will work for you for nothing if you get challenged, because I'm not expecting that to happen.
Okay, and for the benefit of everybody, an aspect inquiry is quite high volume and common inquiry that's made on in respects of one aspect of the tax return, whether that's an individual tax return or a corporation tax return. It's the job of HMRC to do that. So anything that they find and they're not quite sure about, they'll bang off an aspect inquiry to the accountant. It gets answered, and in 99% of cases, that's the end of it. It's only when they're not happy with the answer to such an inquiry that they might then look in more depth and then properly open an in-depth investigation. So I think that's actually quite encouraging what you said, Mark. We've got Alison has come up on. Alison, do you have a question for us? We can't hear you. You might need to press your keyboard. Okay. I'm sorry. I'm trying to. Okay.
Can you hear me now?
We can hear you now, Alison.
I was just wondering if you had a partnership, if all the people in the partnership had to work 20 hours in the business to incorporate with the CGT relief.
No. It's a question of how much the business occupies in terms of time. So you could have 4 or 5 people in a family. They wouldn't all have to work 20 hours a week on it. As long as
okay, that's great.
Yeah. Be a bit hard otherwise, wouldn't it?
Yeah, it would be very hard.
Yeah.
Okay, thank you.
And I'm going to bring in Ingrid. Do you have a question?
Yes, I have. A couple of years ago, I've sold a few of my properties held in my own name, paid off the remaining properties, buy-to-lets. I also have my own home without a mortgage, and of course now with 3 kids, I'm looking at inheritance tax implications. What's the best way forward? Should I just buy additional properties with my daughters into an LLP and then incorporate it?
I think that would be the best way to go, because you already own things in your own name. So that would be a way of mitigating some of the inheritance tax that would arise, because you can then look to incorporate in time to come.
Okay.
So at the moment, there's very little that can be done other than looking at trusts, and that is a complex, and that has its own tax implications on putting things into trust. If the trust runs for a long while, which you probably would do, we would be doing in your case. So certainly, you can put a freeze on the IHT liability if you set up an LLP and then move to a company, if that is still open to you at that point.
And Mark, just you have covered it to a degree, but just could you just clarify the situation if people such as Ingrid would like some, direction from you in writing that they can then give to their accountant and say, look, this is what we're doing. Is that a service that you provide?
together with, well, it's mainly Property 118, the tax consultants there will provide reports and recommendations.
Yeah.
We're happy to work with accountants. We work with accountants a lot and make sure that they understand what is being done. So yes, we quite often will have 3 or 4 way conversations with client, consultant, accountant, and me. So yes, we do give that guidance as part of that service. We don't just do the planning and then throw it over the wall, let you get on with it. We're there to give assistance as time goes on.
Okay. Can we bring Richard back in?
Yeah, just on that subject, I can say that we're part way down the process with Mark. Mark's been quite happy to speak to my accountant all along, been very prompt with questions that's being asked, and to ensure that everybody's been totally comfortable thus far. I can vouch for that.
Great, thank you for that.
Thanks. Rich, you've got another question.
Yes. Is it possible that the director's loan, is it possible to roll over the interest until you reach a point where it benefits you to start pulling money out? For example, when you retire or when you become a lower tax threshold, or is it better to roll that back straight back into the business, even if you're a higher taxpayer, so you increase your director's loan?
The director's loan is repayable to you tax-free, so your tax bracket that you're in doesn't make any difference to when you take it out. You can leave it in as long as you want. You can gift it and put it in trust as well. It's your money. It's your post-tax money.
I think he's referring to charging interest on the loan, Mark.
Oh, right. Yes, you can charge commercial interest on the loan. That would be taxed because it's a benefit that you're getting. You would be taxed on it, but it is a tax efficient thing to do, to charge the company interest on the loan that you've loaned it. So
But would it be best to not withdraw that until you reach a point where you're not a higher rate taxpayer, or would it be beneficial just to hand that director's loan and the interest back it to the company and not withdraw it, so to speak?
That's probably more an accountant's question, because that would be sensitive to each passing year. You can roll the interest. You don't have to take the interest out, but when you do take it out, you will be taxed on it.
So what I mean is like compound interest. So instead of taking it out, you keep putting it back in.
I'm perfectly frank, I don't know the answer to that question. Directors' loans are a bit of a specialised area in terms of the tax implications. If you do anything other than take the money out that you put in, there are tax implications of taking money out or having a director's loan account overdrawn, i.e. you owe the company money. So you need the accountant to advise you about that.
Okay. And when you said when you incorporate with the short-term bridging of say $500,000, how much would that cost for a couple of hours borrowing it?
I don't. Again, it's a lot cheaper than the tax you would save. That's all I know. So that's done through the private and their lawyers. So it is an attractive thing to have. It is, you save a huge amount of tax on it because you're just basically keeping your money liquid. It's always your money, isn't it? It's never anybody else's, but you just need to keep it liquid, keep it out of the share premium account.
Thank you.
Thanks a lot. And we've got Jill with a question on the number of hours a week you've got to work. Hi, Jill.
Yeah, thanks, Rupert, and thanks, Mark. Just a quick question, really. Sorry, I missed the beginning of it. It's just, how would you prove that you've done the 20 hours per week? What sort of questions are you likely to be asked?
I've never known anybody being asked to prove it, apart from one client who had to submit a diary. So basically, they don't send somebody with a clipboard around to follow you for a week to see what you do or don't do. They will basically understand that if you've got 20 properties and you don't have an agent, that you will comfortably qualify for this relief. 20 hours is probably an absolute minimum for that. If it's only 4 or 5 single lets and you've got good tenants who've been there for years, they might raise an eyebrow if you say I'm running a business. But
yeah,
in terms of actually proving it, you can keep a note of what you do. You can go back to emails and diaries and bills that you've had to pay. You can reconstruct your time to adequate proof. But I say I've only ever known it once, and that was adequately dealt with by just a sample of what a typical week or month would be like.
And that brings into mind another question, which is more of the commercialities of using the services to incorporate, insofar as there's likely to be some element of cash negative situation in paying fees in order to avoid future tax. And clearly there is a threshold of which, you know, the income or the number of properties that you've probably got, which would actually make it worthwhile you doing this, rather than just suffering the tax itself, or just finding other ways of repurposing some of those properties, perhaps. Can you give us a ballpark on that?
Yeah, that's the reason why we have this money back guarantee with the initial consultations.
Right.
You don't pay barristers money for telling you that you can't do anything, because that's not how we operate. You go and have a consultation with the 118 team. You pay £400 just to show you're taking it seriously. You'll have a full illustration of where you stand, and if there's nothing that can be done, you get your £400 back again, and all you've wasted is a couple of hours.
Oh, so even the £400 at your initial consultation, if you're not going to move forward, you get the £400 back?
All you've got to do is ask, yeah.
All right.
And so it's risk-free. So then you'd have an illustration of what you can do, what the benefits of it would be, and then you match up the fee as against the tax-saving benefits, and you work out whether it's a value proposition or not.
And just to pick up on Rupert's point, is there a minimum number of properties?
No, it's all about time. It's all about how much time that you spend.
Right.
So if everything's fully managed and you don't ever do anything hands-on, then you're unlikely to be seen as running a business. This is for hands-on landlords who have it operating at least half of their working week on operating their business.
Right.
Okay.
Right. So it does sound very positive. I won't go as far as to say I almost wish that I'd bought in personal name, but nevertheless.
That's the other thing. Anybody starting off on this, you can set yourself up from day one in a scalable and sustainable way by setting your company up in a good way, a group of companies up even. You can make a start from day one in a proper way. And when I see the younger people coming to the events, I tell them there's nothing I can do for you apart from say start off in a company.
Yeah,
and that's free of charge.
So that was fantastic, Mark. I'm sure everybody really appreciated that. I certainly did. And can we just ask everybody, is there any more questions before we close the meeting?
It's been very helpful, thank you.
Oh, pleasure.
Okay, so what I'm going to do, I've had a couple of questions along the way about the presentations, so I'll get the presentation emailed to everybody that's here listening today. I've got your email addresses from your registration, so I'll send that off a bit later this evening. But thanks very much for coming on to the Unity Renowned Speaker session, and thanks very much to Mark for coming all the way from Cirencester and to talk to us.
Absolute pleasure. Thanks everybody.
Okay.
Thanks Rupert.
Thank you.
Okay, bye for now.